The market dipped today, and the major tech stocks are taking a hit. And this is exactly why I'm sitting on heavy cash right now. With two straight years of more than 20% gains in the S&P 500, I expect 2025 to be a rough year for the stock market. And all the big companies' valuations are stretched, and any bad news could trigger sharp sell offs. Let's dive into why I'm cautious and how I'm preparing to take advantage of these dips. First, let's talk about my cash position. I'm sitting on a heavy cash position of $140,000 in my Robinhood portfolio because I believe 2025 could bring significant volatility. After 2 years of massive gains in the S&P 500, a pullback seems inevitable. Historically, markets don't sustain such strong runs without a breather, especially when macroeconomic headwinds like inflation or slowing of rate cuts and growth in the economy come into play. By holding cash, I'm positioning myself to take advantage of opportunities when stock hits my target prices. Remember, it's not about being in the market, it's about being ready when the market gives you a chance to buy quality stocks at discounted prices. Now, let's go over some of my current holdings and their key support levels. First up, we have Microsoft. I currently own 11 shares of Microsoft at an average price of $411, and based on analyst rating, the recent news on AI investments which it's betting on, my price target on Microsoft is above $500. And let's look at the key support levels I am watching. And I'm looking at $408, $397, and $387. I'll add more shares if it drops below these levels. Next, let's look at Meta platforms. I bought 10 shares of Meta last week, and this was in fact my first buy in 2025. Meta recently got analyst upgrade from $630 to $750. So I will buy more shares if the stock drops below my average price. And let's check the key support levels of Meta. So here are the support levels, $590 and $542. And anything below that is a strong buying opportunity as Meta remains a long-term AI and ad tech leader. I consider myself a very conservative investor. I don't believe in investing all of my money at once. Instead, I prefer to patiently wait for the right opportunities and use dollar cost averaging to build positions in high quality companies. This approach not only reduces risk but also ensures I'm taking advantage of market fluctuations over time. By focusing on strong fundamentals and buying quality stocks at reasonable valuations, I'm setting myself up for long term success. Let's look at my next position, which is Nvidia. I currently own 23 shares with an average price of $128. And these are the support levels I'm watching for Nvidia: $128, $114, and $102. I'll be buying aggressively on these levels, especially because of the strong AI trend. And then let's look at my next holding, which is Tesla. I bought 2 shares of Tesla before the election results, and I saw more than 100% gains when it went above $450. And it's cooling down a bit now. It's a great company with a strong moat, so I'm waiting for a dip to buy more and good key levels. Let's look at Tesla's support levels. So $358, $323, and $270. It may never come to these levels, and I'm totally fine with that. But all I'm doing is preparing myself to be in a position to buy instead of watching the opportunities go away. And the last stock in my list is Google. I also bought Google before the elections, and when there were news that Google is going to split up due to pressures from the Department of Justice. I think Google is well positioned to handle all these short term noise and go up from these levels. Let's look at the support levels for Google. And here they are: $183, $169, and $157. These are just a few examples, but the strategy is the same. Focus on buying high quality companies at key technical levels. So, why am I expecting a rough 2025? There are several reasons. The first one is the market cycles. After 2 years of 20% gains, the market is due for a correction or at least slower growth. Next, in my opinion, is economic uncertainty. Slower rate cuts, inflation, or slowing corporate earnings could weigh on stocks. And the last one is investor sentiment. As valuations remain high, the market is vulnerable to sharp sell offs with even a hint of a bad news. Many stocks, especially in the tech sector, are trading at a lofty price to earnings ratios, reflecting optimism about future growth. However, when valuations are stretched, it leaves little room for error. For example, an earnings miss, disappointing guidance, or broader economic concerns like rising interest rates can quickly send stock prices tumbling. History tells us that when expectations are high, the downside can be significant if reality doesn't meet those expectations. This is why I'm cautious going into 2025. By holding cash, I can remain calm and prepared to act if the market presents opportunities during these sell offs. It's not about timing the market, but being ready when the time is right. What do you think? Are you holding cash or fully invested? And which stocks are you watching for potential dips? Let me know in the comments below. If you found this video helpful, don't forget to like, subscribe, and hit the bell icon for more market updates and investing strategies. Thanks for watching, and I'll see you in the next one.